Hello, and welcome to the Wade Borth Podcast. I'm your host, Wade Borth, and in every episode, my goal is to get you to think differently about how money works and ultimately to empower you to take control of your money and your personal financing system. So let's switch gears a little bit here. And again, thank you, Barry Dyke, the master researcher, the author of Pirates of Manhattan 1 and 2, and soon to come Pirates of Manhattan 3. Yeah. When is that coming out, do you think?
Sometime this year. I'm sick of looking at it, but it's well worth it for everybody. So,
and then the book, Guaranteed Income, how how to secure a pension for yourself, which is just a lifetime income. So again, author, speaker, advisor, researcher, wear all the hats, and you're doing well. So thank you so much. You. If people want to find your book, they go to barrymdyke.com. Yeah. So again, Pirates of Manhattan is one of the books that just changed my life. So thank you so much for that. I want to talk a little bit about safety of insurance companies, because you do a lot of research. You talk about, the pension failures that are going on with all the state pensions and, underfunded pensions. And so you see things that we would consider secure that really aren't. Yeah. What's your take on life? How secure are life insurance companies?
Well, when you put it under the microscope and you look at all different types of corporations or financial corporations, whether it be asset manager companies like a mutual fund or a bank or a credit union, and there's so many of these, loan companies and things like that. But if you look at all the companies within the financial universe, and you really analyze, you understand life insurance companies are the most prudent to be with because everything has to be reserved. In other words, as you know, Wade, if you go to the local bank or credit union, if you will, and you have put down $10,000 or $100,000, doesn't matter, that these banks can create money out of thin air. So if someone has $100,000 in the bank, can literally lend out $900,000 to the bank of that money to the public. And actually, since September 2019, they can lend out unlimited amounts. So we know banks, by their very nature, or credit unions for that matter, are very highly leveraged. This is a fact. Read my book if you don't believe it, but this is all true. Or people who are doubting Thomas, Google fraction reserve lending, as you know. But in any event, so it's all kind of a variation of the theme. Credit unions operate under the same basis, but I like them because they're mutually owned, so we don't have the stockholders. But so I prefer credit unions over banks. But anyway, they work somewhat the same, all right? But if I put money into a life company, I have to reserve every last dollar. So, and because they're looking at obligations that 10, 15, 20 years out. So that's why a life insurance company is more stable than a bank. Now, a caveat to that, Wade, is the older I get, and I'll say this to anybody, and this will be in my next book, is that if people are going to be the insurance company is always going to be more stable than a bank or a mutual fund, all right? Just because of how they're structured. Because the asset manager, all they do, they're just collecting fees off your assets. There's no risk to them. All the risk has been really offloaded to the investor or the retail saver. And the banks are very highly leveraged by nature. But a life company, everything has to be structurally sound. Now, but the thing is, you may want to have them on your show at some point, but one of the things which you really want to, if you're going to be using a life company, they want to go through someone like you, and they want to use a mutual company or a fraternal because they don't answer to Wall Street, and they're not participating in a lot of the new shenanigans or financial engineering, or I call it financial sorcery, from Wall Street, where they're setting up reinsurance captives, and they're offloading reserve risks to the Cayman Islands or to Barbados or Bermuda or other places, or the captives in Arizona, Vermont, which are kind of like they're sham agreements. So the thing is, so you really want to use life companies, but you really want to stick with the mutual, the fraternal. Some stock managed companies are very well, but I would stay away from anything which has private equity behind this. Unfortunately, there's a great deal of presence in the life space now of private equity firms. So you have to be real careful.
Our take is we deal solely with good, sound quality mutual companies. I mean, that's the forte. And again, they're ran for your benefit, right? That's, at the end of the day, it's like, it's ran for your benefit. And quite frankly, they just don't have the desire to go do all this shenanigans because they're not trying to please two masters, right? They're policyholders as well as the stock market, right? So they don't have to go create this. They just have to. And it's interesting. I had a CFO, chief financial officer of a, mid-sized, large, $40, $80 billion life insurance company, which is mid-sized, right? To say that. But he made the comment, he says, we don't look at the next quarterly conference call. He says, we look at the next quarter century, right? And so the focus, it's a long-term focus, is so much better. But it's just interesting that when we look at it, because there's always the fear, well, how are life insurance companies doing in this low interest rate environment? they struggle. There's no doubt about it. But like you said, every dollar is reserved for. So they could make, they have to make something, but they don't have to, they don't have to make the 20% or the 15% returns in order to operate.
Yeah, and I think, I don't know if you've been long enough in the business, but do you remember that little company called Indiana called Conseco? Were you in the business? How long you remember?
Oh yeah, I mean I know Conseco's. I've been in the business almost 35
So,
years.
so,
So
so,
I've
so
I
that
remember
was
Conseco.
so
I've been in the Conseco field house in Indianapolis. How's that? I remember when they were actually still a company.
okay. Well, that's that was Wall Street at its fine. Gary Wendt, who was a former GE Capital guy, whatever, and who was the other guy? Stephen Hilbert, whatever. And they partnered up with the private equity firm Thomas Lee of Boston. They put $500 million in preferred shares, and then Conseco ended up being one of the largest corporate bankruptcies of all time. So this is my concern. I mean, so when I know this stuff, and this is people don't believe me. Google Conseco bankruptcy. It's right up there. It's not a Lehman Brothers or an Enron, but it's close. I mean, it's in the top 10. Okay, so this is what happens when Wall Street gets involved with safe savings. And essentially, so this is the problem. So I think people are going to be much better off being with a mutual company.
100%. I mean, I look at Wall Street sees life insurance companies, if they can get access to those huge piles of dull money, and they're salivating, like wringing their hands, like, oh my God, we can make so much off that. We can do so much better. When I say they, I mean them, not the policyholders, not the people that own it. So that's why I said anytime you can kind of divorce yourself from Wall Street, the better off you're going to be. Which kind of leads into my next subject, that we want to talk about is, the idea of 401ks. And again, people are just conditioned to believe it now with the new regs. Maybe we could talk about that too. It happened the 1st of 2023 because we're recording this on January 4th of 23. People are now, by default, going to be in their company or their employer's 401k program.
Yes.
So people don't understand that these are, I think I looked at a article back it was about 7 years ago now. It talked about the real cost of 401ks. When they'll list their fees and their expenses, but those aren't all the fees and expenses that are associated with it. And those are the published ones. Yeah, no, those are like, they're 1%, 1.5%, maybe 2%, depends on what 401k you're using, but they don't show the trading fees and all that. And so this article, I think it was in Forbes or Fortune magazine, I'd have to go back and pull it out, talked about what the real cost could be, and it could be up to 4.5% per year. Have you ever looked at those numbers and then maybe speak to the new 401k rules? Okay,
so in regards to 401ks, there's actually a lot more behind the 401k than people are seeing. In other words, there's things like if you read your brokerage statements tied to your 401k, there's the things which is called sweep accounts. So they'll sweep your money out, and they'll use that for things like margin loans, and they'll lend out your stock to people who want to short the stocks and things like that. So there's a lot more things behind a 401k, which most people don't see. But it's you have to kind of dig behind the curtain. And so there's a lot more out there. And the whole thing is, and there's no guarantees. And then what has happened is that the 401ks are now more complicated, Wade, because in June of 2020, they allowed for the inclusion of private equity into 401k plans. And which is, I can't believe it's a nightmare. And then I think Biden just pushed through some type of ESG agenda, environmental, social, and governance into 401k, which is quite frankly BS. And they're saying, we have to have clean energy and all that stuff. Look, I don't want any pollution more than anybody. But the whole thing is you can't exclude energy out of investments, okay?
That's what we're
and so, but this is what Biden wants to do, but somehow they stuck it into the 401k. So it really is a highway to serfdom. I noticed you have my own book, the book I came out in 2012 behind it, Highway to Serfdom. So it really is a highway to serfdom. So people pushing all their money into this stuff, it has no control of this. Now they can push into alternative investments with debt-based finance, with private equity and hedge funds and all this other crap. And then on top of it, they're throwing ESG stuff on to push this very left agenda. So again, I'm all for clean air, water, and all that stuff. I love that stuff, but this has really gone too far. So but I hope they don't keep blindly putting their money into these things.
Yeah, I agree. Again, to me, they're expensive. The biggest thing is, and I've had arguments with people like, well, these 401ks are, life insurance is so much more expensive. And, we can have a whole other discussion around that, and we can probably prove that's not the case, right? Over time, right? If it depends on which point in time you look at. But over time, they take a lot more money from you than you'll ever pay into it or, possibly pay into it. But more important, it's about the control of the money. So that's what people don't understand. It's not about rate of return. It's not about anything else. It's about control, right? When you have control of your money, then you can direct where you want it. You can have access to it when you need it. You want it. I mean, think about the people how much money was made in 2008 when the market crashed. Those that have access to capital and cash and free and guaranteed money, how much money did they really make? They weren't worried about the rate of return. They were just like, either I survived or we flourished. The pandemic was the same way. I had companies that borrowed against their life insurance policies to hundreds of thousands of dollars to keep their company, going when it wasn't real clear that they were going to be able to do that. And even to the bigger point, they were able to take advantage of somebody else's chaos to buy out their competition. And now, coming out of the pandemic, they're twice or three times bigger than they were going into it. And so access to money and control of the money is the most important part. And that's what people kind of forget, is that it's not so much rate of return, which that's what Wall Street tries to sell you. And they do it really poorly, by the way. They sell it to you real well, but they're, what's the old adage? You got to break some eggs to make an omelet, but we have yet to see an omelet come out of Wall Street. Right?
Yeah, and the whole thing, it's, if you, and then they look at, I'm a registered investment advisor, so everything I have to say has to be prudent and factual and the whole thing like that. But if I'm a media outlet, I'm exempt from the Investment Advisor Act of 1940. So everything I'm saying here has to be true and accurate, okay? So I'm kind of a high visibility guy anyhow because I've written all the books I've written, but so everything I say has to be very factual, and I'll testify any of the stuff you and I are talking about right now. But if I'm the media, I could, as long as they say their stuff is general in content, they're exempt from all this stuff. So, and who are the biggest advertisers in the media now are the banks, finance companies, things like that. I mean, mobile phones and auto companies are big up there, but so they don't want to bite the hand that feeds them. And that's unfortunate, but this is what's going on right now. So that's why they're not hearing the truth. But this is why I put in the book is that how, companies like CBS or, the BBC, which are huge media organizations, how they actually bought annuities from their own account. Even NPR. I actually pulled up the NPR, National Public Radio. The only reason I've been introduced to all these companies like CNBC and things like that, and Bloomberg, and the door's been slammed in my face, I don't know how many times, but even NPR, and I think I talked to NPR, I tried talking to them for 35 times, whatever, I gave up, but so I pulled their 5,500 for their retirement plan, and lo and behold, 60% of the money's in fixed annuities for all the people who work for NPR, National Public Radio, so, which is one of the, 12,000 stations like that in the United States, but do as I say, not as I do.
And I get this a lot from clients too. They go, oh, if this is so great, this idea of putting your money into properly structured life insurance and using for the controlling the banking function of your life. If they say, if that's so great, why isn't everybody else doing it? I said, there are a ton of people doing it, but nobody's talking about it on the TV because, they're not spending money. You look at, if you have cable, how many channels are just designated just to Wall Street, right? There's CNBC, there's
Fox Business, there's Bloomberg,
Fox Business,
Bloomberg,
right?
Yeah.
There's just a ton of them, right? So there's this big megaphone out there that's blaring and you go, well, why isn't anybody doing what you're saying? I'm like, there is a ton of people, but it's usually quiet because it's a private contract between you and the insurance company. You don't have to talk about it.
Yeah, so what that's the whole thing. But if you have Comcast out, I don't know, North Dakota, whatever.
Yeah, I'm familiar with Comcast.
Okay, well, actually, one of the biggest life insurance claims of all time was Ralph Roberts, or is it Brian Roberts? Ralph and Brian are the two founders of Comcast, and they paid out over $496 million in life insurance benefits in 2016. So yes, but you never hear about this on CNBC or NBC or whatever. But how many, the largest life insurance claim I ever found in my life was roughly almost $500 million on one of the founders of Comcast.
Wow, that's big.
So this is the truth, but it's just, again, anyone who's listening out there, don't believe me, Google it or contact my office and I'll share it with you. It's all true.
Yeah, like I said, if you want research, read your books, read your research material. It's fabulous. So one other thing I want to talk about, and then I'll let you go, and I appreciate your time so much today. I can't express my gratitude enough, and so thank you again. But this thing that is in the news, been in the news for quite a while, and it's actually in the news a lot lately, for not performing is digital currency and the Fed. I know we probably could make a whole show of this, but just in general, give me your take on where do you see this going, just your take on just digital currency in general. And especially the Fed coins. I'm just amazed. That was released on a Friday afternoon that, by the way, the Fed's going to start its own digital currency.
Well, it intellectually kind of makes sense, I guess. if there's some, intellectually, if there's some type of a gold standard, okay, I guess at some point, I guess we're going to see it in a lifetime at some point. But the way I look at it right now, with Charlie Munger, Warren Buffett's partner, said, he says he looked at digital currencies like rat poison. In the sense that it's just another scam. I mean, essentially the digital currencies promise to free people of the traditional banking system. But in fact, this is what this guy Sam Bankman-Fried was doing with FTX and whatever. He's creating money out of thin air and using it as leverage. And but there wasn't even a common platform. So this what makes it even more risky. So it's another tulip mania. It's another South Sea bubble. And I think the collapse of FTX, Wade is probably one of the greatest financial. It's much bigger than Bernie Madoff, and it's one of the biggest scams. Now the irony of the whole thing is that all the institutional investors who were involved in FTX, so all these supposedly smart people. If you bear with me, I can pull it up on right now. So the people, I got the investors who were actually in FTX. I'll just share some of this for your readers. But this is all public information from the bankruptcy reports. But the FTX.
And I think while you're looking that up, let's have a little commentary on that. Is that, the idea of cryptocurrency in my mind is I go back to kind of what Nelson says, that the banking function should be done at the you and me level, where the currency could be done at the you and me level as well, theoretically, right? And so what happens, I think, when we look at cryptocurrencies, the idea of cryptocurrency, I like. The implementation, at least right now, I think is very sketchy.
Yeah, it is. I mean, it's intellectually, sometimes maybe, I don't know if in our lifetime, but it does seem to make sense if there's some kind of uniform standard. But my point is that, so you have all these, of course, we had Tom Brady and Gisele Bündchen, the NFL quarterback, when he was a big investor in it. We had the giant private equity firm, Thoma Bravo, was invested into it. Van Eck Associates, the mutual fund company. Let's see, Paul Tudor Jones, his family office, Englander, Hudson River Trading, Coinbase. Let's see, Alan Howard invested in this thing. BlackRock, private equity invested into FTX. Sequoia Capital, which is kind of the Maserati of venture capital. It's incredible. Tiger Global Management, which is the big hedge fund, New York hedge fund with Chase Coleman and all these guys. And SoftBank, the giant private equity venture capital firm out of Japan. They all put serious money into. Let's see what else do we have here. These are just So Teachers Venture, which is a pension money from the Canada. So all these major institutions put in, I believe, close to $1 billion into FTX. And from what I can see, they did absolutely no research. The finances on this thing I don't even know if they had a balance sheet. Whatever Sam Bankman-Fried wanted to figure it was worth. But this is the whole thing: is they bought the politicians, but they went crazy with that, and then those commercials and stuff like that.
Because here's one thing I saw, I think it was Mass Mutual. They put $50 million, and again, $50 million from Mass Mutual is
not a lot of
change
money
that falls out of their pockets. That's not a lot of money, but the idea of buying $50 million in cryptocurrency was actually kind of a shocker. I was like, and I know a lot of people were rejoicing. It's about time they get in, the stodgy insurance companies get into this. I'm like, again, it's about the return of your capital, not the return on your capital. And so I was really surprised that Mass Mutual got into bed with cryptocurrencies, as small as that was, right?
I was kind of surprised as well. But it's this whole, it's kind of funny thing, the madness of Karaji, or we call it FOMO, fear of missing out. And I remember even doing a financial plan for a young man a couple of years ago. And he said, "Well, Barry, I like you." And he said, "Well, and I did the whole plan for him." And I'm going to do some insurance in New York. Very smart. And he said, "Well, I believe in crypto and, have fun staying poor, and, and then, he had, I think he had Bitcoin at the time, right? But maybe like $40,000 a coin. I don't know what it is now, 16 grand, something like that.
16.
So, so you can't get something for nothing. But this is what they do with the cryptos, and there's no inherent value in this stuff. But we go from one mania to the next. So last time we had subprime mortgages. This time we've got cryptos. We got stock buybacks. We got SPACs, which we haven't even gotten into, special purpose acquisition companies. We've got electric vehicles. And flying taxis and all this stuff. They spent $100 billion in that stuff, and it's autonomous vehicles. We're a long way. Even Ford and General Motors essentially said, "Hey, we give up." We're a long way from self-driving cars. But as you know, Wade, probably 2-3 years ago, it was the thing.
100%. Because the point I'll make, and then I'll let you go, is, we're in the business. It's funny because to that client of yours that, was in crypto, he says, good luck being poor. And I really believe that the industry we're in and the job that, at least my focus, especially with like property structured life insurance and what we do with it, is we don't, in essence, make people rich. We just keep them from becoming poor. And then we give them the freedom to go find ways, because that life insurance policy isn't on its own, isn't going to give you the mega wealth that somebody wants to promise through an illustration. And that's part of our industry's problem, is that it uses an illustration and then we set expectations. And there's a real issue there, but it's about, I'm going to keep you from becoming poor because I'm going to give you a safe, secure, guaranteed asset that you can use as a foundation to go do other things. And where people want is that they want this one-stop shop. Like, hey, I want to, I see VULs are now coming back into vogue, right? It's like the craziest thing in the world. Variable universal life. I fall out of my chair when I see that after what I saw in the late 90s and early 2000s. But they're coming back into vogue because people want access to a part of it is some of these large insurance companies want to take those liabilities off their books and shift it over to the market and then put that back on the clients. So they're doing the same thing that pensions did, or 401ks are doing to clients.
So that's the whole thing. So we're just trying to help put seatbelts and guardrails around people's savings, and care about them, and we have to be a bit of missionaries, if you will, but that's just the way it is. And the other stuff, they really don't. And I mean, I sleep at night. I know you do at night, but I don't know how these guys from Wall Street, the asset managers, sleep at night, because the carnage has been incredible, and who knows what's going to happen. But I hope your guest and check out, go to barrymdike.com, Wade, if people want to get a book.
Yep. Well, I appreciate your time. We appreciate your research. Thank you so much for your time. This has been incredible. I could talk to you for another 2 hours, but I know you don't have the time and I don't have the time. We'll have to do it again, and then we'll have to see each other hopefully sometime soon.
Thank you, Wade.
Thank you, Barry. Appreciate it.
Thank you.
If you're enjoying this podcast or know anyone else that might be interested, please be sure to hit the subscribe button and please leave a review. This will help this podcast reach and help more people by ranking higher in searches, and ultimately help more people get out of financial bondage. And don't be afraid to share this podcast with your friends and family, as we can be easily found on Apple Podcasts and Spotify.